Well, one investment that has done well recently has been the precious metals market, gold and silver, and even some of the metals stock. But there's a disparity in the markets today. Just go out and try to find bullion. And if you can get it, what are you going to pay for it in the way of a premium? In contrast to the paper market. So today's discussion, we're going to take a look at paper and physical and why you want to own physical. Joining us on the program is Dave Morgan. He's editor of the Morgan Report, and Ronan Manly. He's a precious metals analyst with BullionStar in Singapore. Dave, I'm going to direct this question to you as we begin, and that is the futures market sometimes is often in different directions from what's going in the bullion market, and that's the case today. I mean, if you're able to try to get precious metals, I don't care if you're buying Eagles, Maple Leafs, Krugerrands, they're in short supply if you can get them, and the premiums have never been this large, at least in terms of the last decade or so. So what's going on, and how would you explain the difference between what's going on in the physical market and then what's going on in the bullion market?
Well, Jim, this is David Morgan. As you stated, there really are two different markets. I mean, the COMEX, the CME-run paper market is a derivative market, basically. Yes, there are warehouses or vaults that hold physical silver, but the primary purpose of that market is a derivative of the physical silver market. So when you get into the retail market, which is where a lot of investors put their money with bars, coins, government rounds, or whatever, and there's congestion in the market, meaning the demand is so high for that retail product that cannot be met, the premiums soar. Now, we saw this in the 2008 financial crisis, and I wrote an article about the arbitrage opportunity, and I was going contra to some of the silver bugs, saying that I thought that you would see the premiums fall back and come more normalized to what the silver or the derivatives market was producing as a price. And actually, that's what happened. We've been seeing congestion in the market almost its entire year. And to the best of my knowledge, the premiums on retail products have held up above average the whole time. They started to subside a few months ago. And then once this Wall Street Bets Reddit subgroup Wall Street Silver came on board, the premiums have soared and stayed there. The one final statement I want to make is that in all of my 40 years of following this market rather closely, I have never seen a premium on a 1,000-ounce bar at the level we have now. Few of the primary dealers that I know from the A-marks on down are looking at like 80 cents to $1, $1.20 in that range, Jim, to take delivery of commercial bar silver. So I'll just leave it at that. There's a lot of demand, and there's not apparently enough supply to meet that demand at the current time.
The premiums that you're seeing in the physical market and basically the paper market, which has gone nowhere here probably for the last 3 or 4 months. Usually, if you think about economics, the way it works, if you have a lot more demand for something than there is supply, the price would go up. Why is it going up in the bullion market and it's not going up in the paper market, either one of you?
I'll take it, and Ronan can add on to it. Again, it's a derivatives market, and as much as there's a lot of questions surrounding the derivatives market, for the most part, the commercial bar market has had enough supply from whatever the source, from a refinery direct or a smelter direct, not necessarily coming off the COMEX, to meet the true physical demand. But right now, that's not taking place. But we've got to look at it a bit deeper, Jim, and that means that the 1,000-ounce bar that's going to become, let's say, a government-minted coin has got to be shipped to, let's say, the Sunshine Refinery. Then it's melted down, then it's poured and it's extruded, then it's punched, and then there's a die made, and you punch in to the blank the Silver Eagle. So that whole process adds like $2 or $3 to the price. Obviously, you had to transport it, labor involved, machinery involved, everything involved. So the market for silver is the commercial bar market. The retail market has to do with coins and everything else and has a premium built in just to the process. But where the dislocation comes in is where you get these huge wide spreads and they move into the physical market as I just mentioned, commercial bars having a premium. To me, that speaks that something's going on in this market that we haven't seen in my lifetime. And I just like to defer to Ronan, if I might, to maybe poke holes in what I said or elaborate on it.
Yeah, I agree with what David is saying. What we're seeing, we need to make a differentiation between the retail market and the wholesale market. From a physical retail point of view, there always will be premiums on bars and coins above the spot price because that reflects fabrication costs, transport, marketing, distribution. But then if you think about up from the retail side to the wholesalers, to the refiners and mints, when retailers buy physical bullion, coins and bars, they also have to pay above the spot price because that reflects refining, fabrication, etc. And we are actually lucky in a way because being based in Singapore, we have good relationships with different distributors and refineries in Asia. And for example, we take a lot of silver from Heraeus in Hong Kong. And Heraeus are quoting much higher premiums between them and us than they would usually do so. And that's because they also, where they source their metal, either from back along the supply chain or from the interbank market, they're seeing that banks are quoting them premiums higher than normal. So that's something that we didn't see back in March 2020, April and May 2020, when there was dislocation between COMEX and London in the gold market, which then spread into silver. There were normal premiums on the wholesale silver market back then, but now the premiums in the wholesale market have doubled and nearly tripled, which, again, to reiterate what David was saying, that has never happened before. So it suggests that the silver squeeze, the demand for silver from the whole retail market backwards, all the way up the chain, has started reflecting in higher premiums. But getting on quickly to the paper markets, and Jim, what you mentioned about the divergence in price between the spot silver price that's derived in COMEX and London LBMA versus the retail market. We've done a lot of articles and research over the years on this very issue. The fact that the paper markets drive the price discovery and not the physical markets. So a lot of academics have occurred with this as well, that COMEX trading volumes and LBMA unallocated trading volumes in London literally dictate the price of spot. So no matter what is going on in the physical markets, that doesn't really show up readily until maybe now going forward. So if you think about it, the unit of trading in London that the LBMA banks trade amongst themselves is unallocated silver. It's literally silver credit that they create out of thin air, and it's not really backed by physical. And then in COMEX, you've got silver futures, which are a derivative. So overall, everything that dictates the price is a derivative. And if it's in unlimited supply, then they can trade these units, and it has no bearing on what's going on in the physical market.
So do you ever see when there is a disparity, as we're seeing today, where you're paying these large premiums in the physical market, where basically in the paper market, you're not seeing that? What about, does it ever get to a point where it corrects and it balances out?
Jim, I'd like to go ahead and quote Kyle Bass on that. He sent out this tweet on the 10th of February, 2021, and quote, "If more than 5% of the contract holders of the front month silver take delivery, it will cause significant problems for the exchange. It's always been this way. The Hunt family figured this out in 1980. If the subredditors knew what was said to them in a backroom meeting, ... end quote." So it works until it doesn't work. We've talked about it in the past with you, Jim, on Financial Sense, that there's two markets and that the physical at some point could and possibly would take over the derivative market. And my main thesis is that this doesn't happen very often. It only happens if you look at the big picture, I call it, which is the failure of fiat currencies and a breakdown in trust and confidence in the entire system. And I think that's what is basically driving this, whether people know it consciously or subconsciously.
Well, it's amazing because I've talked to a bullion dealer who I used to deal with. She deals mainly with hedge funds. And she said going back to March of last year, she's just had difficulty obtaining product. And you wouldn't notice that if you were looking at some of the prices that you've seen in the, let's say, paper market. So this is something that many people may not realize. In many ways, the paper markets operate almost like a fractional reserve system. And let me explain what I'm getting to here. If you deposit money in a bank, let's say I put $100 into a bank. Well, that bank is not going to sit on that money. They're going to loan out 90 cents. They'll keep 10 cents in reserves for cash. So all the money you put in a bank doesn't have all that money in cash on deposit. Likewise, it was explained to me once that in the futures market, you may have paper contracts that far exceed what they have in inventory because in a way it operates almost like on a fractional system. Any one of you want to take that up? And also, number two, let's say, as Kyle Bass was talking about, it would overwhelm the market if 5% of people took delivery. But there's a little clause in the futures market that says, hey, if you have a silver contract and we don't have the silver to deliver, we could just settle in cash. Either one of you want to pick up on that?
I'll quickly interject. We did a whole chapter in the Silver Manifesto about fractional reserve bullion banking, but I'd like to hear what Roland has to add.
Yeah, I think it's important to look at both markets, London and COMEX, from the point of view of the fractional reserve market, because they are both examples of fractional reserve silver markets. In London, you've got the LBMA every month comes out with statistics saying they have such amount in their vaults. Currently, they say there's 33,600 tons in all of their vaults, which are literally the HSBC vault, JP Morgan, ICBC Standard Bank, and some of the security carriers, you'd call them, Brinks, Malcolm, Mid, and Lomas. And altogether, so there's 33,600 tons. So the LBMA would have you believe, and their bullion bank members, that's a lot of silver, and there's plentiful supply of silver to go around. But what you have to realize is that nearly all of that silver is already held by exchange-traded funds, which hold their silver in London. The biggest one of those is the iShares Silver Trust, SLV, which has about 20,000 tons. But there's about 13, 14 other ETFs, which in total hold another 7,500 tons. So overall, these 14 ETFs, and they're run by providers like Aberdeen Standard, Wisdom Tree, Invesco, Deutsche Bank, EWS. So all of these in total have around 28,000 tons of silver of that 33,600 tons that's in London. So that doesn't really leave very much for anyone else after you take into account what the ETFs hold. So looking at the fractional reserve nature then of the trading in the silver market in London, if you take away all the silver that's in the ETFs, there's only around 7,000 tons, excluding the ETFs, which could be used to back up unallocated position trading in London. So if big institutions who have unallocated silver positions suddenly want to convert 500 tons, 1,000 tons, there's not very many times that they can do that. And we have to also remember that with this silver squeeze, a lot of traders on the Wall Street Silver, Wall Street Bets crowd, they're buying SLV, or they were buying SLV until they started switching to PSLV. But the point is that back in late January, early February, over 3 days, the 29th of January and I think it was the 2nd and 3rd of February, literally 3,500 tons was added to just SLV. And if that happened another one or two times, there wouldn't be any silver in London to back any of that. And then if you turn your attention to COMEX, so the COMEX inventories right now, they say there's about 12,300 tons. 2/3 of that, 8,000 tons, is eligible, and the rest, 4,200, is registered. Registered means that there's a warrant attached, and that has been involved in COMEX silver contract trading. The other 8,000 tons eligible doesn't necessarily have anything to do with COMEX trading. The COMEX rulebook says that all the approved vaults in New York and the CNT and Delaware vaults have to report their eligible holdings of silver, which means any silver that's 1,000 ounce bar and could be used for trading, but it doesn't necessarily have anything to do with trading. So straight away, as David mentioned, we're nearly at the end of February, and the first notice date for the March silver contract is coming up. I think it's tomorrow night or Friday morning. And if there was, for example, 20,000 contracts standing for delivery, or even 15,000, that's nearly like between 3,000 and 2,500 tons. And that could pretty quickly eat into the registered total of 4,000. So the margins are quite slim. And that kind of feeds into what you were mentioning about Kyle Bass. I'm not really too well up on the actual force majeure clause. So maybe David could talk about that.
Well, I can add on that, it's been a while since I've read the entire contract. Most people that sign up for a futures contract never bother. But the bottom line is they can settle in cash. And, I'll just leave it at that.
I want to focus here on silver just for a moment because it's a monetary metal. It's an industrial metal. Man, Dave, when you first introduced me to silver back in the 00 decade early on, a lot of silver was used in photography. Of course, we've gone a long ways now with digital photography and our cell phones. And a lot of silver was taken from scrap. It was recycled. Contrast that today where you have, let's say, silver being used in solar panels with the green economy. You have it used in electronics. But Dave, I just don't see the recycling in electronics. Are you going to really get that much silver out of a cell phone?
Yeah, that's a tough question. I mean, right now, the biggest recycling year that I can recall from memory was, I think, 1999. It was over 200 million ounces, and almost all of that was photographic waste. The current level, depending on which study you look at, somewhere around the 170 million, and it's claimed that most of that is electronic waste. What I do know is that as the industrial demand continues, especially with the quote-unquote green revolution, you're going to see less and less available. Yes, there'll always be recycled silver. There's people that will smelt coins, actually, but jewelry, silverware, other items, and electronic waste. I think there's an opportunity actually in the e-waste sector. I won't address it here, Jim, but it's not back up to the level it was during the photographic era.
So when you take a look at the use of precious metals, and they've always been a store of value throughout human history, I wonder if you'd both like to comment now on the competition coming in from cryptocurrencies. You've got some pretty big hitters out there like Elon Musk that talked about putting quite a bit into Bitcoin. What has that done to the precious metals market? I know a lot of the millennials and a lot of the Robinhood traders are into the cryptocurrencies, but what impact has that had on precious metals?
David Morgan, I'll take a stab at that. It's opinion. It has had an effect. And what's interesting to me is that a lot of the early adopters to the crypto story were the silver bugs. A lot of people that are in the silver market don't have as much risk aversion as gold people do, which means that they're willing to take more risk. So anecdotal evidence from more than one source, several people that were in silver that were disappointed with it going down or sideways took their, their monster boxes of silver, cashed it in and bought Bitcoin primarily and watched it take off. I think most of that change took place much earlier than what's happening recently with the city in the news. And that's a lot of the, let's say, wealthier class that's moving from gold into Bitcoin. This is it's typical of how these markets move. And that's my take. I think it's distracted a lot. I think, this idea that Bitcoin is gold 2.0 really kind of is humorous to me. It's so much different than the gold market. And if I could just add one other thing that really hasn't been out in the consciousness of the investing public very much, is what I call hybrid, which is a cryptocurrency that's associated with the precious metals exactly. And this, I think, is the future that many people are not accounting for an increased demand over the next 5 years or so. If you could use your phone and transmit digital silver or gold in, let's say, 4 seconds flat, and have something as stable as the precious metals are over a longer term, I think that whole system could catch on rapidly and probably pervasive throughout, let's say, the entire globe.
I was going to talk a little bit in general about your previous question, Jim, about cryptocurrencies and how that has maybe brought in new investors from different spaces. What we've seen is that young crypto investors are actually using some of the profits that they've made on cryptocurrencies to move and diversify into physical gold and silver. And in BullionStar, we've been offering the ability for customers to buy bullion using cryptocurrency since 2014, when we introduced Bitcoin as a transaction currency for buying bullion. And then subsequently, we introduced Ethereum and Litecoin and Bitcoin Cash in 2018. So I think that there are always going to be extremists in different markets, people that like gold, don't like silver, like bullion, but don't like crypto. And even to the extent of people who only like Bitcoin and won't hear anything about altcoins, they'll dismiss them. So I think that in general, the cryptocurrency revolution has been, in a way, good for introducing more people to bullion. And there are also a lot of the silver and gold bugs. Now, you see that, you can really feel it on Twitter, that they're moving over into crypto, but they're not forgetting about bullion. They're trying to harness the features of both. I think that the vault bullion angle on crypto is interesting because if you take it back a step further to do with blockchain, in essence, Bitcoin was the first blockchain, and that created a whole new mathematical theory about how you can store holdings and have confidence that only one person at any time has those, and you can move those holdings and be confident that they've moved to the right place and all the records are on the ledger are up to date. So it is a fascinating technological development that vault holdings can now be put on a blockchain, and that companies can offer their customers, in a way, an interface into their vault holdings, and knowing that customers can have confidence in knowing that those vault holdings are going to be there and that they can move them because of the fact that they're built on a blockchain. And everyone that's younger than ourselves for the last 10, 15 years understands that intuitively about blockchains. So they have a lot of confidence.
You know, as we take a look at what we're going on, and certainly as we take a look globally on the events that have unfolded over the last 12 months with the pandemic, the lockdowns, we're seeing money printing, we're seeing fiscal government spending like we have never seen, at least in my lifetime. They're talking about budget deficits this year that exceed 4 to 5 trillion, depending on how much money they're going to spend. We all know they haven't repealed the laws of economics. Sooner or later, there's going to come a day where this is going to have to play out. I mean, any government cannot print money and spend money and just print to pay for it. If that was the case, places like Zimbabwe would be as prosperous as the U.S. So when that comes, and it's my belief that you're going to see a dollar devaluation, a major devaluation of all currencies. What happens as we're seeing right now, just in the pandemic, where people are scrambling, they're trying to get bullion. The bullion is going for a premium if you can get it. What happens when things really start to get chaotic in the markets and you're just not going to be able to get it?
Well, Jim, I tweeted out last night a couple of movie clips from the movie Rollover. And when I started on the speaking circuit about 20 years ago, I used to use a film clip of that movie to emphasize the point that we are possibly entering a situation like that. And I think we're getting closer to it. You've already answered your own question, and I know you know that, but you get into a manic phase where people will do almost anything to preserve their purchasing power. And whether or not we're going to, to what level, what degree that happens remains to be determined. In fact, I could be off base. But when someone with the gravitas of Michael Burry, who was the person in the Big Short movie recently put on his Twitter account that he's seeing the adaptation toward a hyperinflation taking place vis-a-vis what the Federal Reserve Board is doing. It does give you pause. I do and have done from basically inception when we met each other, Jim, saying that you need a hedge position. You don't need a philosophical bent that only the precious metals are real money and therefore that's the only place I invest. I want to stay balanced and sincere. On the other side of the coin, however, you do need a hedge position, and you really want one 6 months before the panic starts.
Dave, if people are having a hard time right now getting a hold of physical, I mean, I'm on a major website right now, and I don't care if I'm looking at gold eagles, gold buffaloes, Canadian maple leafs, Krugerrands, silver eagles, silver buffaloes, platinum coins, they're out of stock. So what does one do if you're trying to get it? Are you safe paying the kind of premiums that are being demanded right now?
Yeah, in Singapore, we're still able to get quite a wide variety of products delivered to us from our distributors because we have connections around Asia. But for example, like silver eagles are out of stock. There's a very long lead time on that. I think there will come a time in the next few weeks where the availability will become even less. In the States, I've been looking at all the US and Canadian dealers. That started before it's hit Asia. And it is worrying that all of the dealers, when they get products, they're sold out instantly. And that seems to be a trend that will continue. But I think that securing bullion in the form of bars or coins right now, I wouldn't be worried about paying high premiums because I don't think it's going to get any better. Like the premiums won't go down, they'll only go up because the availability blockage, so to speak, isn't going to be resolved anytime soon.
So when you're taking a look at these premiums right here, what would you suggest if you go to these websites and everything's out of stock? You just keep going back each day and hoping you get them at the right time when a shipment comes in?
Jim, a couple of things come to mind. One is you're dealing with an established dealer you can trust. You might be able to take delayed delivery as long as you're willing to, put up your fiat and wait 6-8 weeks. So that's one option that could be available from some of the larger dealers. The other part is where you go next. I mean, having lived through the 1970s and into the 1980 top, I know what happens, or at least what happened, and I would expect it to happen again. Anything gold and silver related starts to become a hot topic. So the mining shares get the idea that I can't get silver delivered. It's impossible, or I don't want to pay that kind of premium. Well, that will spill over into where does it come from? Well, it comes from the silver mining community. So you will see people that will run into the mining community because that's the only place to secure some type of silver or gold exposure. And of course, as you well know, Jim, that's what happened in the 1930s when it was illegal for U.S. citizens to own physical gold. They moved into Homestake and Dome Mines primarily, and those two stocks went to the stratosphere in a few short years during the Great Depression. So that's what comes to my mind, Jim, is if you can't have the physical, which is the best, and I've always advocated that, the next best would be the top tier cash-rich unhedged mining companies and anything below that in classification.
So if you can't get it, the next alternative would be to go who produces it. It's an interesting story, and I'll just throw this out. I had a client that was relating a story to me. He was buying his silver directly from a silver company. They would have like silver rounds, silver bars. And he went to put in a large order because he saw silver taking off just like we do. We have taken a major position in the base metals plus silver. And he was saying that he could no longer buy from them. They took the selling off their site. And when he called them up to talk to him, he said, well, everything we have right now, we're being shipped to Wall Street. So it sounds to me like somebody's trying to cover a short position.
Well, it does. I mean, I don't want to get too excited. I think there's enough stress in the market just from what we can determine, absolutely. But another anecdotal story, one of, let's say, the larger clients I have on the commercial side wanted to get shots. Silver shots pretty much used in the commercial area. And so I connected him with one of the wholesalers that I'm familiar with. And basically they said, it isn't that we don't have it. It's just that it's all accounted for. We're not taking any new buyers. Sorry, And I think that's happening almost everywhere from what I've been able to determine. I mean, the physical supply is tight and getting tighter. And as the public smells this, they're going to basically get into that, I'll call it, I hate to use the word, but this panic or manic mode, which I think will happen at the top of the market. We're certainly not there yet. But I do think, as Ronan said, and I wouldn't have agreed with this in 2008 and 9, but I am now. I think the premiums are here to stay. I could be wrong, but that's not the way the market looks, at least currently.
Well, certainly, I don't care what kind of coin you're looking for. There's a premium in, and even if you pay the premium, the real question is, can you still get the stuff? So I guess as we kind of summarize and close here, what would you recommend to individuals right now, both Ronan and Dave, to comment on this, when you can't get the metals right now? I mean, try to get a gold eagle, gold buffalo, maple leaf, good luck. And I don't care if it's gold or silver. What would you be telling people to do?
Well, Jim, I'm not a dealer, so I'm biased because the main focus of the Morgan Report has been riches and resources through the equity markets, and that's what I specialize in. It's not just silver, but now it's been focused on gold and silver over the last couple of years because that's what the market has been telling us. We like copper. We just wrote up 3 copper situations a couple months ago, and copper's going straight up, as you well know. So I think that's the best exposure, and I just want to warn people that buying cheap stocks is not the best way to go from a very experienced point of view. You want to start with the stalwarts. You want the main household names, the blue chips. And once you have a solid base in that part of the market, then you can branch out and speculate and that type of thing.
I would say that to answer your question and also to comment on your previous question about pricing and the fact that you've got the Wall Street spot price and then you've got premiums, people should really sit back and think about the pricing of physical versus the pricing of paper and not really look at it as a premium to the spot price. We are starting to think in BullionStar that the spot price that comes from Wall Street and London is not really relevant at all, and that we might start pricing on a fixed price basis based on an equilibrium price that reflects supply and demand. And that really evolves into that people shouldn't be thinking about what the price in dollar terms is of gold and silver, but about how much physical ounces of gold and silver they can accumulate. Because after all, gold and silver are real ultimate forms of money, and they have been for thousands of years. So people shouldn't really be fixated about what the premium is to a spot price that is derived on the paper market, but about how much physical they can accumulate. I think that there is still gold and silver available, investment gold and silver, but you will have to look more widely to find it. And for example, like we source from Hong Kong and Turkey, not just from the States, so that outside the US and Canada, there is still metal flowing into different places like Hong Kong and Asia.
Well, it's absolutely amazing. I would say this, there's going to come a point in the future where you're just not going to be able to get it at all. Never mind what premiums that are out there right now. And given the fact that you may not be able to get it in the future, do you ever see a point, Dave or Ronan, where the physical market actually drives the price versus the paper market, which has driven it for decades?
Well, I've said it for years, Jim, and my belief system is that, as I said earlier in the interview, that there comes a time very rarely in monetary history where there's a disconnect between the trust and confidence factor that governments pretend to be all-knowing, omniscient, all-seeing, and, rule over us with their monetary masters, and enough of the public wakes up and says the emperor has no clothes. I can bite this. I trust it. This has been money for thousands of years, and that's what I need to have. And I think we've hit that. I don't know. I don't want to get too excited, but all indications are something happened, as Ronan explained, early on just a few weeks ago where we had this huge inflow into the ETPs, and it looks as if that stress may have caused something that will come to fruition as time marches forward.
Ronan, if our listeners would like to contact you regarding the purchase of bullion, how could they do so?
Well, we have a shop and showroom in Singapore. It's actually expanded recently. It's very large and very impressive. But if you are outside Singapore, you can log on to our transactional website, www.bullionStar.com, and you can buy and sell precious metals, silver, gold, platinum, numismatics, even bullion jewelry. We have a very large product range still. And if anyone wants to follow BullionStar on Twitter, it's at BullionStar. It's quite easy to find. And if anyone wanted to even email me, my email is ronan.manly@bullionstar.com, MANLY.
Best thing is go to our main webpage, themorganreport.com, and get on our free newsletter service. If you're interested in the subscription service, just pull down the subscribe menu and you can have a look.
That concludes my interview with Dave Morgan and Ronan Manly from BullionStar. I wanted to cover this topic because, as you saw a couple of weeks ago with GameStop, the next one that they were supposedly the traders were going after was a silver short position. That lasted about a single day before authorities moved in and put a stop to it. But here's the point I want to make. Right now, if you want bullion, you're going to have to pay a premium. But here's the thing. Even if you have to pay a premium, you can still get it. That may not be the case. And one of the things that really struck me, especially when it comes to silver. Silver is an industrial metal as well as being a precious metal. And all the electronic devices you think about, your iPads, your iPhones, all the electronic devices that we have today, and also the way silver is being used as a biocide and also in green energy with solar panels. Wait till you see the commercial companies like an Apple or somebody else figure out that there's going to be a shortage of silver, and you get the industrial companies that actually use silver in manufacturing start stepping in the market and buying and taking delivery off the COMEX. Man, will you see sparks fly. The point I'm making is you should always have some physical bullion, gold, silver, whatever your preference is, and have that as a hedge against everything else. And what I would say, given what I'm seeing unfold here, it may not be too far down the road where you just simply won't be able to get it because the demand will be so great. I'm Jim Puplava. Thanks for listening.